applications of financial statement analysis, the two key areas which we always talk about, they are either used in credit appraisals and credit analysis, mostly used by banks and all these kind of companies, or probably they are used heavily in equity analysis and valuations. Two major areas. But most of these, in both these analysis, what we typically use is we do calculations on the historical data, ratios, or probably looking at the increase from year to year or common size or whatever is the analysis we are doing. We are not doing on the future, we are doing on the historical data, but use that historical data, right? We do some kind of calculations on income statement, balance sheet over the last few years of the company as well as industry as well as competitors. We do all these kind of things. The reason being, using the historical numbers, we try to forecast the future. Okay, at what rate the sales of this company have been growing over the last 5 years. Based on that, I will assess at what rate they will grow next year. These are the various inputs, and probably, okay, the cost of goods sold, around 70% of the revenues every year. So probably next year also, I can assume that the company's cost of goods sold will be around 70% of the revenue. So to address these kind of things, what generally the financial analysts do is first compare the various ratios and various calculations on the historical data. Because today, if I have to invest, right, or if I have to give a loan, I should be least bothered about the past. How much profitable the company will be in the future is what is my major objective. But I am still looking at the past financial statements, because using them, I want to create the future financial statements, whether it is in a credit analysis or in an equity analysis. The major thing that happens is using the past financial statements, using various calculations on the past financial statement, people try to create futuristic financial statements. And based on the futuristic financial statement, they get into the either the credit analysis part or the equity analysis part. So they establish some kind of trends based on various ratios, all efficiency or profitability, various ratios. The intention is to understand the pattern. Okay, is it more stable? Is this ratio more stable? Or is it more growing? Is it more falling? Or what is the industry average for this? What is the based on that, they want to come out with some number for the next year or for the next few years. So all the ratios are typically computed for the simple reason to understand the trend over the past few years, so that they can give one number for the future. And based on that, they want to prepare a future P&L statement, future balance sheet, and future cash flow statement. That is what is the root for valuation. Right? Finance always believes in is always based on future, not the past. But we are doing the past analysis so that we can put better numbers for the future. So we are trying to make some kind of trends, right, based on which I can compare them with the past of the company as well as with the competitors as well as with the industry average, to really understand what numbers I should put for the future. This will help me in understanding the business strategy of the company. Are they spending more on advertising, or are they spending more on employees? Because once I understand the various costs, I can understand the business strategy of the company. And in any typical kind of forecasting mechanism, first we will forecast the sales growth. There are various mechanisms which will be applicable to forecast the sales growth. Either I can simply use last 5 years on an average they have grown at 10%. So next few years also assume the growth to be around 10%. That's a very simple kind of stuff. Otherwise, people get into linking it with respect to economy. Okay, when the GDP growth was around 8%, this company growed around 15%. So probably next year the GDP growth is only forecasted at 6%. So probably this company will grow only at 12% or 13%. Something like that is a slightly more advanced way of predicting your sales growth. But once the sales growth is predicted using your common size and various ratios which link the sales, there are so many ratios that link up the sales. We have so many profitability margin, net profit margin, gross profit margin, or probably turnover ratios, asset turnover. They are all having sales as one of the element.